Welcome to More Than Mortgages. I'm Chad Anderson. Today, Zach and I are going to break down interest rates. Now, you may think, well, what is there to break down? Well, you've always heard, do I pay points? Do I want to buy down the rate? Well, did you also know you can take a higher interest rate and get a credit? So, just like you pay to get a lower rate, you can take a higher rate and get a credit towards your closing costs. But in this market, does it make sense? So, we're going to show you that breakdown, how that works, the math that goes with it, and we'll discuss and see what we think based on what's going on today, because obviously that can be different in a different situation than what's happened in the past or what will happen in the future. So let's bring Zach Jones here to the stage. How you doing, buddy?
I'm good, man. I'm good. I'm looking forward to taking a little peek behind the curtain of interest rates and talking about a little some industry secrets. I think that a lot of people just don't know how mortgage pricing works, so we're going to teach that today.
Yeah, it's going to be very surface level because there's so many rabbit holes you can go down on this. And then people say, well, when does it make sense to do what you guys are talking about? And we'll give one or two examples, but the best way and the easiest way to figure it out is simply reach out to one of us. And so that really, because every scenario, every situation is going to be so customizable and specific to
Right.
you and your life and what's going on, that really just talking to one of us is the way to do it. So you can start there by liking, following, subscribing, hitting the bell, DMing, commenting, whatever you got, or follow us on our other socials. We've got those over here: YouTube, Instagram, Facebook. He's at Zach Jones Loans. I'm at This Chat Is Real. So hang out with us, keep up with us, whatever you want to do, but we're on those different platforms. So Zach, what a lot of people don't know, we'll share my screen here in just a moment and bring up the chart, but what a lot of people don't know, and I don't know how often you have this conversation with people, but just like you can get a lower rate and buy down discount points, there's a little bit of an inverted method to that also. Like I said in the opening, of taking a higher interest rate, and let's say that the rate you choose, if you want to go lower, costs you $3,000. Well, there might be a rate that you could take that's higher that actually gives you a credit of $2,000, meaning,
Right.
hey, if total closing costs are 10 or 15 grand, well, now if you've got a $2,000 credit, it's only 8 grand or 13 grand or $2,000 off what it would be. And so it saves a little money that comes out of your pocket. But how often do you actually talk to people about this? How many people even understand that this is an option?
Well, I think that most people don't understand it, and it's a really interesting question about how often I talk about it because in the past I've used it a lot. It's particularly beneficial in certain situations in certain markets. The reason that I haven't talked about it like at all in the last probably, I don't even know, man, 3 years
Hmm.
is because the market has not been friendly to the pricing structure, and that's what one of the things that we're going to see in the example that we're going to give. It just hasn't been friendly to giving very much credit for the price that you pay in terms of the interest rate. So in simpler times, in simpler markets, it has been something that I've used where people were short on funds to close and they needed a little help from the lender, and we bumped the interest rate up a little bit. I've had some particularly strategic customers who maybe utilized what we used to call, and I still call, premium pricing, where you get a credit back from the lender. Some particularly strategic clients who have done that because they were maybe going to pay the loan off relatively quickly. And I can also remember a particular new construction client who just simply didn't have enough money to close when they got to the end of the game. They
Yeah.
literally, technically, took the family on a Disney cruise. You know how expensive those are, if anybody
I
does.
don't, but we're
Uh,
about to find out. Maybe, but yeah, I get it.
so he took the family on a Disney cruise and spent his closing costs. So we had to
God.
bump the interest rate at the end to try to get him over the hump, and he got there. He was a particularly undisciplined borrower. We had to do a lot of things to try to get him over the line. So it does work for some people in some situations, but we really have not talked about it much in the last several months, couple of years.
If you need help on getting a fast pass for Space Mountain or the location of a Mickey ice cream bar in the Magic Kingdom, I'm your guy. All right, I got it. But I don't know the cruise problems yet. I've heard that they're proud of their ships.
Yeah.
Is the rumor going around town. All right, so let's bring this up here. Pull this up on stage. So here is an interest rate example. Now, again, keep in mind, if you don't know, this is a complete example, information, education only. I'm not offering you these interest rates, not an offer to lend. Every rate and every closing cost and discount point is going to vary by scenario. So before any of you try to crucify me, probably me more than Zach, I'm just here to tell you right now, this is, again, example purposes only. So don't expect this interest rate. All right. So let's start off with the par rate. And we're going off of national average here. Okay. Again, this is what Mortgage News Daily just has as their national average. So that's what we're using. And honestly, I think they actually charge on their average rate. I think they even charge a point. So this is a little bit wrong. But again, this is for information and example purposes only.
So explain par to people who don't play golf.
Yeah, let's get I wish I knew what par was when it comes to golf. All right, so if we look at the loan amount, we're going to go off of $400,000 in our example here. So 6.99% is what is called, in this scenario, the par rate, meaning that there are no discount points. There's no additional cost to get this rate. So if you wanted 6.99% and you qualified, and this is your scenario, then that means the par rate, being this, doesn't cost anything additional for you to get it. Okay. That's it. Very simple, straightforward. That's almost just the middle ground. Okay. This is Switzerland right here. Just hanging out in the middle.
The even rate, you're not incurring any additional closing costs or discount points in order to get that average rate for all lenders in your lending scenario, or for all borrowers in your lending scenario.
And so if you follow along, we're going to put the rate here, the discount points here, and what that actually costs over here on the far right. So if you're looking now, let's say you want to buy the rate down, and we'll do that first because that's the most common scenario. Notice these aren't exact increments. The rates go down 1/8, but just because each rate goes down 1/8, which is 0.125%, and the formulas here rounded off, so that's why it's a little bit barely off. But you see here, to go down 1/8 in this scenario, it costs you 0.375, and that's in discount points. So, well, what does that mean? Well, over here on the right, we have the dollar cost. So the dollar cost means $400,000 times 0.375%, otherwise known as 0.00375, comes out to be $1,500. So your closing costs will be whatever they are. And then if you want this interest rate, the 6.875 or 6.88 rate is going to cost an additional $1,500. Now, you can go 1/8 lower, and guess what? It's another $1,500. Okay. Same. So you can go from par, which is no cost, to 6.75 and spend $3,000, 0.75% of 400,000. So it's $3,000. And that's what would be your additional closing costs on top of everything else. And then the last thing, I'm going to let Zach chime in, is, again, I said it's not all equal. That's a much deeper conversation as to why certain rates have certain jumps compared to the others. We're not getting into that today. It's only a 15-20-minute show. All right. That's an entire 20-hour course all on its own. But if you notice here, you go down another 8, 6.625. Well, it only goes to one discount point. Again, in this example, which is only a 0.25 difference instead of a 0.375 difference. So instead of a $1,500 jump in closing or discount costs, it's only an extra $1,000 jump. and close or discount costs. That is important to understand though, because when you start looking at buying down a rate with your loan officer, there may be an option somewhere in here where the gap is narrower between two rates. And so you say, well, shoot, I almost feel like I'm getting a bargain right here because I'm going another eighth lower, but I'm only having to spend 1,000 to get this one instead of 1,500 to get these other two. So what did I miss on that, Zach? That's like the most simple ABC example we can give. And that's not to talk down to anyone, but this stuff is confusing. There are people in the industry who don't get this stuff. And this is just first the baby step example on how discount points work.
Right. And you did a good job of explaining it. The thing, one of the things that's really complicated about this is that these numbers and these spreads between rates literally change all the time. It's not exactly like a stock ticker where, you know, you're moving up and down all day long, but on a volatile day, you could literally, this could change a few times. So it's very fluid in the way that you look at it. And usually when I'm talking to a customer at the first run, when we're initially pre-approved and not locking a rate or even really talking seriously about rates, the general rule of thumb, and this example is a little bit better, but the general rule of thumb is that one discount point is typically going to buy you about 0.25% off the rate.
Yeah.
And so this one buys you about 0.3% off the rate. So this is a little bit more aggressive example, but it's relatively typical because you're looking, or at least I'm looking as a loan officer for the sweet spot in that rate sheet. And right now, the market has been pricing this for at least 18 months. The sweet spot is always going to come around that 1% or that one discount point. That's where there's an incentive. There's an extra incentive to kind of push you into buying a 1% buy down. And that's the way the industry is marketing it, because everybody expects that these rates are going to go down over the relatively long term, the next 12 to 24 months. And so lenders are really pushing that sweet spot 1 point buy down in the way that they price mortgage loans. Everybody is. Everybody's unique.
So here's something to keep in mind as we go down a small rabbit hole here. This is where you have to put on your thinking cap and you really have to trust who you're working with. Like it's so vital here, because if you're at 6.99 and this is par, meaning there's no additional cost. Okay. You say, yeah, but I want to get a lower rate, because most of the time the reason is because their neighbor has a lower rate. Let's be honest. They want to brag at the church social that they didn't get the highest rate out of the community, because then they feel like a dummy.
Something feels good about 6.75 versus 6.99. So actually, something feels better about 6.99 than 7.0.
It's what I call the Walmart theory. I mean, they price things at 99 cents, not at $1. Because imagine, you want to put Dollar General out of business, just go open the 99-cent store.
Right.
Literally, people's brains, that's where they go. Is the 99-cent store sounds better than the dollar store. Meanwhile, none of us care about a penny. If I walked up to you and said, "Here's a penny," you'd slap me for wasting your time.
Well, but the Dollar Tree is a $1.25 tree now.
Yeah,
everything is $1.25 in there now.
Yeah, so. They didn't rebrand with inflation.
They didn't change the name.
Yeah, no, they didn't rebrand. The Dollar Tree and Dollar General is the most bait and switch operation in the entire United States. All right.
Yeah.
So, all right. Here's the thing to my point. I just did it while Zach was talking. The difference in 699 and 6625 on 400,000 is $100 a month. So now you have to go, okay, well, if I'm saving $100 a month, $4,000 to save 100. How many of you would do that? How many of you would spend 4 to save 1? That's 40 months. That's 3 years and 4 months. So here are 2 questions I ask people. I say, look, do you think rates are going to go down in the next 40 months? If the answer is yes, and you truly believe that, it's not a hope, but it's a conviction, and there are forecasts and projections about it, then at that point you have to step back and go, it doesn't make sense to spend this much money to save that little, because unless you get to the 40 or the 40th month, you've lost. Now, the longer you hold on to it, the less you lose, right? Like if you hold the loan for 20 months, then it costs you $2,000 that you lost. But if you hold it for 6 months, it costs you $3,400.
So let's be clear here. You're doing a break-even analysis, and this is great because it's $100 increments.
Yeah,
So
it worked out. That was an accident and worked out.
Yeah, but it's a great example. So I'm going to spend $4,000 to buy an interest rate down that saves me $100 a month, which means that if I refinance in 18 months because interest rates come down and it's advantageous to me, then I've only saved 18 months, but I paid $4,000 at closing to do that. Yeah. That math sucks.
That's one way to put it, right? It does, though. It does. So those are the things you have to think about. And also the second piece of that I challenge everyone on is, we're recording this in February of 2024. So let's go back 3 years and 4 months, which would have been October of 2020. Okay. Imagine your life in October of 2020 and imagine your life today. Are you in the same house? Do you have the same number of kids? Do you have the same cars? Do you have the same jobs? Things change. Mm-hmm. So to try to convince yourself that things are going to be exactly the same as they are today in 3 years and 4 months, odds are you're wrong. Odds are they're not, because life happens, things happen, rates change. You want to refinance, you want to sell, you get divorced, you have a kid you didn't expect, you want a bigger house, your kids get older, you want to get in a different school district, your job relocates you. There are infinite examples of how things change. So you really have to think about this. And what I personally, I don't like to stretch it out more than like a 2 year kind of recoupment. Yeah, because 2 years, it's such a short, even if I'm wrong, it's only, if I held it for a year, then I only lost a year.
Right.
And a year of savings. Like I could swallow losing $1,200 over time. If you spend $4,000 and in 6 months rates do go down and you've now lost 3,400, that's a lot. That's a lot of money, Not that 1,200 isn't, but 3,400 is a much bigger chunk than 1,200.
And it's something that you can exert a little bit of control over. I mean, if rates go down and you find a better loan and works better for you and you save a bunch of money, that's awesome. Mm-hmm. But you got to be thoughtful in your projections, kind of looking forward. And I like the 2-year rule because that's the one that I use most often in refinances as well, which is a break-even analysis. How much is it going to cost me, and how much am I going to save? It's an investment in a new loan term, a new credit agreement, new money. You're buying money here.
So to wrap up the show, this is the flip side. So there's really not much to explain other than two things. One, the obvious. You can take a higher interest rate, kind of like we briefly said early on in the show, and you can take 7.125 or 7.13 because it rounded, and you get a negative 0.2, which means you get $800 credited back to you at closing. So if the difference in payment from here to here is about $33 or so a month, well, you're getting a credit now. You're paying $33 a month to save $800. If you go here and you spend $67 extra per month, but you save $1,800. So what does that come out to be? 26, 27 months, somewhere in there. You can go up 3/8, just like you could go down 3/8. You save $2,400 on your closing costs. You're spending an extra 100, but you're saving $2,400. Now you may say, this is the second piece of it. Well, Chad, why are you saving less? Because up here you're spending $4,000, but for this 3/8, you're only saving $2,400. That's the part that's the deep rabbit hole. That's the tricky piece of the economy and the housing market, mortgage-backed securities and coupons and the bond market and 10-year treasuries and all these things that we watch on a daily basis. And the truth is right now, and maybe Zach's going to be better at articulating this as he can wrap it up for us today. When you talk about this, is that people on Wall Street also know that rates will go down at some point. They're going to come back down. So they're simply not going to let you take this loan with big credits. So they lower your credit. They forcefully lower your credit and don't give you the same return, because if you take this loan and refinance it, there are penalties to them. Penalties if it's done in less than 6 months, if it's done in less than a year, and I even believe if it's done in less than 2 years, but the penalties get smaller as you go. So that's why the higher your rate, the faster you're going to refinance. So in an indirect way, they are going to penalize you for taking the higher interest rates. And that's why they don't give you the same return.
In simpler terms, they're doing the same break-even analysis that you should be doing, which is, if I'm given a credit back, I need to have this person making payments, interest payments back to me as long as possible, because I've got to make up that money and then make a profit.
Yeah.
So the whole industry, everything about pricing in the industry right now is geared toward lower interest rates, which is one of these things that we can look at behind the scenes and skip all the media hype and skip all the real estate agents and their Facebook and Instagram posts and the mortgage people promoting, rates are coming down, and whoever it is talking about the Fed and the presidential debate and everything else. The industry understands that rates are coming down, and the proof is in the pudding or the pricing. That's basically what we're running on. And so that in my mind, Chad, that's something that's substantive and I can trust. It doesn't have a spin on it, because this is a financial instrument and the investors need to make money on it. And so they've got the decrease in interest rates over the near term priced into the way that they put all these coupons together.
Yep. So that's the short of it. Again, this was very like vanilla example, but just know that if you talk to myself or Zach, that when we quote you something, all of this is factoring into our brains, and we're looking at the rate sheet in this way. And sometimes that's why we're asking you questions such as, what's the plan? Is this a 3-year home, a 10-year home? What is it? What are your plans? Tell me about your goals. Tell me about your family. Those kinds of things. It's not to pry. It's because we're trying to present the best options for you. And even though sometimes you may not get the lowest rate, and the next time you're at the old ice cream social hanging out and everybody's talking about what interest rate they got, just because somebody says they got 6.63, you don't know what they spent on the 6.63. And you might be the smarter one who played the game better, even though your rate may be a little bit higher. So
you really do live in an Andy Griffith world with this reference to the ice cream social, don't you?
Look, if you want to turn this 23-minute show into an hour show, we can talk about Andy Griffith all afternoon.
I'm going to take you with me to the Andy Griffith trivia night, because I'm sure you'd win it.
I'll tell you a story about that. So there's a game, and I'll tell you a story about that. I just feel like that sounds like a little more rated G than saying, when you're sitting around at Jason Aldean's on Broadway and you're 8 deep.
Yeah.
I mean,
trying to stay off of Scoop Nashville.
I am. You're right. Unlike some others we know. Right. I am trying to stay off of it. All right. That's it for us. Again, like, follow, subscribe, hit the bell, DM, drop in the comments. Does this make sense to you? Do you agree? Do you have a different spin on it? We'd love to know. Appreciate you guys hanging out and following us as always and giving the feedback. So for Zach, I'm Chad, and we'll catch you on the next video next week. Take care.
Thanks for joining us.